How to build a $1 million portfolio on an average salary. Hook. You make $50,000 a year. That's 75 grand after taxes. You're not getting rich from your paycheck. But here's what nobody tells you. You can still build a $1 million portfolio before you're 50. And I'm going to show you exactly how in the next 6 minutes. Stay with me because this isn't about getting lucky with stocks or starting a business. This is about the math that actually works. Part 1. The math that changes everything. Let's be real. You're not saving $1 million from your salary. You're making it through compound growth. That's the secret every millionaire knows. Here's the setup. You're making $50,000 annually. After taxes, you have about $35,000 to spend on living expenses. That leaves you room to save maybe $10,000 per year. Some months you save $1,200. Other months you save $800. But you're consistent. Now here's where it gets interesting. You take that $10,000 and invest it in a Roth IRA and a taxable brokerage account at Fidelity or Vanguard. You put it all in a low-cost S&P 500 index fund. Nothing complicated. No individual stocks. No day trading. The market historically returns about 10% per year on average. Some years it's up 30%. Some years it's down 20%. But over decades, it averages 10%. If you invest $10,000 per year for 30 years, and you get 10% annual returns, you end up with over $1.6 million. Let me say that again. 10 grand a year, 30 years, compound growth, and you're a millionaire plus. That's not luck. That's not inheritance. That's math. Part 2. How to actually do it. Now you're thinking, okay, but how do I actually save 10 grand on 50 grand salary? Here's the real breakdown. Step 1. Automate your 401k. If your employer offers a 401k, you contribute at least enough to get the full company match. That's free money. If your company matches 5%, you contribute 5%. Most people don't do this and leave thousands on the table every year. Step 2. Max your Roth IRA. For 2024, you can contribute $7,000 per year to a Roth IRA. That's about $580 per month. This money grows tax-free forever. You'll never pay taxes on the gains. Step 3. Additional investments. After you've hit those, put whatever extra you can into a taxable brokerage account at Fidelity or Vanguard. Same S&P 500 index fund. Same strategy. Step 4. The lifestyle piece. The reason this works is because you're not trying to get rich fast, you're living on your means. You make $50,000. You spend about $35,000. You invest the rest. You don't need the fancy car. You don't need to eat out 5 times a week. But here's the kicker. You're not being cheap or miserable. You're just intentional. You're choosing your future over your impulses. Part 3. What happens when you actually do this? Let's look at real numbers. Year 5. You've saved $50,000. With compound growth, you're at about $70,000. You're feeling it. Year 10. You've saved $100,000. Compound growth puts you at $175,000. Now you're thinking about this differently. Year 15. You've saved $150,000. You're at about $350,000 total. People start noticing you're different. You're not stressed about money. Year 20. You've invested $200,000. Compound growth gives you over $600,000. You have options now. You could leave a bad job. You could negotiate harder. You could take risks. Year 25. $1,200,000. You're not the highest earner in your friend group. You're not the one bragging about your salary. But you're the one with actual wealth. The final piece. The hardest part isn't the math. It's staying consistent when the market drops 30%. It's not touching your investments when you want to upgrade your lifestyle. It's choosing the boring index fund over the hot stock tip. But if you can do that, if you can be boring and consistent for 3 decades, you become a millionaire on an average salary. Call to action. If this resonates with you, subscribe right now. I post videos every single day about building real wealth on a normal income. Hit the notification bell so you don't miss the next one. You've got this. Let's go.